This is actually possibly the most important question in investment, and it's one that I think we give too little thought to. How should I size my bet? This is a copy of the Financial Times. Now, obviously the headlines tell me news that's already happened, but imagine if instead they were telling me tomorrow's news. And I'm a trader, I buy and sell stocks and bonds. How do you think I'm going to do?
Well, Josh Roberts, our capital markets correspondent, I think you'd rake it in.
Well, you might think so, but a couple of researchers have actually done an experiment that is very like this. They invited 120 people to look at tomorrow's newspapers every day for 15 trading days and then place bets on stocks and bonds. And the surprise is, even with that crystal ball, they actually did pretty badly.
OK, so idiot's guide to markets here. Obviously, markets move on financial information, how businesses have done, all sorts of things like that, but also on global trends, on political information, on data releases, that kind of thing. And yet you're saying that even if people knew what was going to happen, they'd still do badly on the stock market?
Yeah, so some of the biggest events that move markets, as you said, they're data releases. Things like jobs reports. Where is unemployment? How many jobs have been added to the economy? How is inflation doing? Are central banks going to move interest rates up or down? These are the sorts of events that the participants in the experiment were shown in tomorrow's news. If you know that the economy's added a lot of jobs, you might think the economy's growing quite quickly. That will cheer shareholders. Share prices are going to go up. You might place a bet in advance that shares are going to go up. Similarly, if you think the Federal Reserve is going to raise interest rates, you might think that bonds are going to do badly because bond prices tend to fall when interest rates go up. However, even with that information, which you might think was the key that would unlock markets for you, yes, the participants didn't do particularly well in placing their trades.
So how does this study work, Josh? Did they just give everyone a crystal ball and tell them to get on with it?
So, yeah, obviously we don't actually have access to tomorrow's headlines. So this was a team of researchers at Elm Wealth, which is an investment firm. And what they did was they picked 15 front pages of the Wall Street Journal between 2008 and 2022. And they recruited some participants and they showed each participant for each of 15 trading days tomorrow's headlines. Then what you get to do is say you can buy or sell stocks, you can buy or sell bonds. And they gave each participant leverage to do this with. So you could multiply your bet by up to 50 times. This is the sort of bet that hedge funds actually get to place in real life. At the end of the trading day, based on the actual market moves from that historical trading day, your trade gets closed out, and we do that 50 times. Now, each participant was given $50 to start with, and you might think that they made loads and loads of money, but actually only about half of them ended up with more money than they started. 1 in 6 went completely bust. They lost everything. And the average return was very small. The average person ended up finishing with about $51. So despite the crystal ball, they didn't do great.
So what does all that mean? Why are we so bad?
One of the things is that even with tomorrow's news, it's surprisingly hard to guess the direction markets are going to move in. Markets don't just move based on the news that's happened. They move based on what people are already expecting. Say tomorrow there's a great jobs announcement, but everybody was already expecting that. Well, the news has already been priced into shares today. So I might see tomorrow's news, think, stocks are going to go up. But, the economy added 100,000 jobs. People expected it was going to add 150,000 jobs. People are actually quite disappointed. So it's quite hard to work out the direction. And our participants here were not great at guessing directions. They got them right only about 51% of the time. So that tells you something of why they did badly. Even worse than this, though, is how they sized their bets. This turns out to be one of the hardest things to do in trading and investment. You want to be able to work out how confident you are in the move you're taking, and you want to be able to size your bet appropriately, right? If you just think markets might go up tomorrow, you probably either wouldn't bet or you might bet a very small amount. If you feel really confident, this is definitely going to be an upward move, you should be able to take account of that and bet more. But what they found in this experiment is that people are very bad at doing that. They didn't size their bets according to how confident they were. And even when there was news they were shown that made it really, really likely that they had got their bet right, they didn't increase the size of their bets. Conversely, people took far too much risk and multiplied bets far too many times when they weren't very sure, and that's what led to people going bust.
So we're bad at predicting what might happen, and we're bad at predicting how likely it is that that might happen.
There's another surprising element of this experiment, which is they then repeated it with artificial intelligence models. And even the artificial intelligence models did badly. They were a little bit better than humans at guessing the direction of markets. They got that about 60% of the time. But they were pretty much as bad at sizing their bets correctly. Even the machines, who are supposed to be our future overlords, took way too much risk, didn't really kind of calibrate their bets according to how confident they were. And some of them lost money as well.
Personally, I find that quite comforting that the machines aren't brilliant at this. Is anyone any good at this?
Well, we might take some comfort from the fact that the professionals actually are quite good at this. Macro traders, who are traders who bet on the things that we've been talking about, direction of stocks and bonds based on economic and political trends. The researchers at Elm Wealth recruited 5 expert macro traders and gave them the same test. As you might expect, they did rather well. All 5 of them finished with profits. On average, they over doubled their money. And actually, the crucial distinction between them, the AI models, and the lay participants, let's call them, was not that they were loads better at predicting directions, although they were a bit better at predicting directions. It was they changed their investment sizing massively according to their confidence. On some days, they chose not to bet at all. On days they felt very confident, they chose to massively ramp up the leverage of their bet, and it worked out very well for them. So we can take some comfort from the fact that the people who do this day in, day out in Wall Street in the City of London actually are quite good at it.
Where does this leave the existential question, particularly working at The Economist? Are the markets rational? Are the rest of us irrational?
I think markets can be both rational and completely wrong. And what I mean by that is it may well be that markets aren't brilliant at predicting how much a company is going to earn in the future, how much the economy is going to grow in the future. But if I'm a participant in markets, I might not actually care about whether the prediction is accurate. I might just care about making money. So if I know that the market might incorrectly predict the future, but I think it's going to move in a certain direction nevertheless, it makes sense for me to bet on that direction, even though it might lead to a price in the market that predicts the future incorrectly. I think the biggest lesson from this study, though, is that a lot of investors spend loads of time thinking about what they should be buying. How, which stocks should I buy? Should I buy this government bond or that government bond? Should I lend to massive companies developing AI? We devote a lot of thought to those things. But almost, if not more important, is the question of how much. How confident am I that the particular investment I'm making is going to pay off? And can I quantify that? And how should I size my bet in order to take advantage of my confidence? This is actually possibly the most important question in investment, and it's one that I think we give too little thought to.
Josh, thank you very much.
Rosie, thank you.